National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And today, what every producer should know about taxes with special guest Ken Davis, CPA. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And today with me again, the extreme fiduciary, the highly credentialed Mr. TaxFax himself, Ken Davis, CLU, ChFC, CFP, and CPA. Welcome to the show, Ken.
Hey, Stephen. Good to see you again.
Man, I just want to get us a limerick and a little tune to that little credential. You know, I love that. Ken, we've been all this week. If you missed any of this show, you've missed out. We're talking about taxes, but as it relates to producer knowledge, to front our products, and to show how we can have a major league impact on your 1040. And with that being said, again, I just want to show you this beautiful piece from AXA, and I mean, it is really sweet. This is a 1040 overlay. It has a great transparency. If you want to order this, just write us 1-800-290, well, write us. I guess you can't write on a telephone. Call us 1-800-290-7226, extension 147. But if you do want to write the biz at brokersalliance.com, and we'll send it to you. And as long as AXA keeps sending it to us, we'll keep sending it out. I'm living off this now because it's not only a great tutorial so that you can kind of get a little idea of what we've been talking about, but it's an excellent piece with a client. I mean, it is excellent. And by the way, a little side note, we pulled off this all this week, especially yesterday. The Lincoln Benefit put out their 2012 tax update. It's a great 2-page summary. You'll want to have this laminated. I know that there are people that own little stores that laminate this stuff for you. I mean, I'm just telling you. Okay. Well, let's just talk about today. We're talking about some more of the qualified plans, and we talked about the traditional stuff, the IRAs, and I think people are kind of know about that. Now, I noticed, Ken, that you're not only Mr. CPA, but you're kind of getting hipper to the talk, because I notice you don't call 401k plans anymore. You just say K plans.
Yeah,
I feel like I'm being tweeted on the air.
Well, I'm so tired of this, this long moniker when you're trying to talk about it. So I just call regular 401k plans K plans, and Roth K plans for the other types.
Well, so. I mean, that is so hip, and we're trying to be street hip in our 50s. I love that. Okay.
Yeah, good luck with that.
Yeah. So talk a little bit about that, because we're making defined contributions to K plans, to profit sharing plans. We're looking at the extra benefits, some of the tax benefits similar to IRAs on some of this.
Right.
Talk a little bit about that.
Well, tax deferral is really the theme of today's show, because we're talking about the beginning of the year. We're talking about beginning of the year planning. And we can't just suddenly create all this tax deferral at year end. We have to make contributions to things. That's a little easier to do with IRAs. When you get into company and 401ks, you pay it as you go. But the sooner you get the money into your deferred accounts, the more powerful it is. And we went through the other segment and showed how you had.
By the way, just let me make sure, if you missed that, I can't remember what day it was. I think it was Wednesday or Tuesday. I can't remember, Tuesday or Wednesday show. Ken took a brief from our big package. It's all tax are all for you for free. Just call us on it. I have to tell you that it's really great, because the power of tax deferral, that's one thing. The power of tax deferral at the front of the year versus the end of the year is even more powerful. I mean, it wasn't Albert Einstein who said the greatest thing he ever discovered wasn't E = MC squared. It was
time value of money.
Time value of money, compounded money, and the sooner you start, the better the number is.
Right. And the other thing too is people say, well, gee, I want to wait till year end because I'm going to get a deduction, then I'll file the return and get a refund. Well, or I'll reduce my taxes. Remember that a lot of our clients are self-employed or whatever, and are making quarterly contributions, estimates, tax payment estimates. And if they start doing this and can anticipate a reduction in taxes over the entire year by starting earlier, then they can reduce their estimated payments. So you actually start doing tax projections at the beginning of the year and see what the impact would be.
Well, Ken, I think that's huge, because I'm just looking at some of these bigger ticket items. I mean, where you can give some serious money as self-employed, and some of these
Well, talk about big tickets. Go look at our Section 79 program we did last week. And if you get an owner of a business putting $100,000 away and getting $30,000 in tax deductions because he's doing this right now, then he's going to impact he can reduce his estimated tax payments.
Well, this is a huge issue for you from a sales point of view, because we're taking the cash flow down, really, because we're paying less taxes on our quarterly estimates.
Well, we as salespeople are always trying to do what's right for our clients, but we also have to create some sort of urgency. And one of the things you can do with this is the clients say, well, it's not tax year in and whatever, and they're just not terribly excited about deferral as a concept. But if you can start doing things like what I just talked about, then and reduce the estimated payments, then you can say, well, gee, the earlier you do this, the more impact it has. So in the kit, if you order it, there is a sheet. It's just a single sheet that you can pull out and show to your clients and show them how it can benefit them doing it earlier instead of later. So we can create that urgency. Yes, it's a legitimate thing, but it helps us by getting people to focus now instead of year end.
Well, when I think about all the plans that are out there, I mean, because there's a lot of changes in cash balance plans, defined benefit, defined contribution, straight up K plans, as you call them.
Well, let's talk about the cash balance plans. So the history of qualified plans is it used to be that employees stayed with their employer forever, and they had defined benefit plans, and all this money was being put away. And defined benefit, basically, instead of defining what the contribution is going to be, they define what the end result is going to be, what the employee will get at retirement based on their expected earnings over that period of time. And that's all gone away because the cost of a small employer putting large amounts away for themselves means they could put large amounts away for their employees if they're anywhere near close to their age. And so sometimes defined benefit plans can work for small employers. More often than not, they don't. So we went to the 401k model, profit sharing with employee contributions, and that's the K plan. So that's been popular. Now we're back again. Congress says, gee, why aren't more employers doing defined benefit types of plans? And they said, well, because they're not getting enough bang for their buck. So they liberalized the rules, and we have this combination of a defined contribution plan, profit sharing type plan, and we have a similar defined benefit plan. And the numbers I've seen frequently, you can get about 85% of the contribution under these cash balance plans can go to the owner's pocket. So there are, administrative costs and maybe actuaries and that kind of thing, certainly for defined benefit plans. So you have to be cognizant of that. But the fact of the matter is that we can get more of the money to the employers. They're a bit hamstrung because they have to keep making certain levels of contribution for a while to justify this whole thing. But yeah, there's much more liberal rules. So if our agents have their clients in their small businesses, they can talk to them about cash balance plans, and they can start putting some serious money away, and you can fund those with group annuity contracts and stuff like that.
We have a couple of carriers that are into this big time.
Yeah.
I mean, huge.
Yep.
And of course, we have some relationships with some third-party administrators and people that are really deep in this that could really be profitable for you. So if you say, gee, Steve, I'm really not sure what you guys are really addressing on the qualified plan. I know what it is. If you need information on defined benefit plans, defined contribution, cash balance plans, what are all these profit sharing plans?
Right.
We have all that for you, and we can get it out to you. Just write us, thebiz@brokersalliance.com, or just call 1-800-290-7226, extension 147, and say, hey, I want any kind of the information that you have on the defined benefit, defined contribution, divine. I wish,
the divine benefit.
The divine benefit.
Well,
plan.
that's for benefits after you pass away, right?
Hey, but wait, there's more. Not only does insurance cover you during your lifetime. Wow.
Divine benefit. Wow, I like that.
I feel like I'm selling salvation now.
I think the government's more powerful than we thought.
Wow. Yeah. Well, they're not that powerful. I can tell you that. Rome,
well,
if Rome fell, I'm not that enthused.
Let's make this easy on our agents too, because the fact of the matter is, usually you don't have to be a whiz at this stuff. You can simply just say, "Would you like me to help you get some higher deductions?" And what client's going to say no. You say, well, all I need to do is capture your census data information, some basic information, and let us pass it on to some professional people that do nothing but this all day long and crunch numbers. And we send it off to these carriers or people that do this, and generally they're going to do a free review for you and give you some sort of proposal, and you can look at it and say, yeah, this looks pretty good. And you go back to your client and say, hey, I had them look at this, and this is about what we expect you can put away in the deductions. And you could run that through your tax projection software, see what your savings are, and suddenly this looks good. I mean, for instance, think about it. Let's say a small employer has been putting $100,000 away each year into a defined contribution plan. And let's say that 50,000, close to 50,000 went into their pocket and 50,000 went into the other employees. Well, gosh, 50,000 at a 40% combined tax bracket is 20 grand in savings, yet he's paying 50,000 to the other employees plus the administrative costs. Not a good deal. It may be just to keep the employees happy a good deal, but certainly not for them on an economic basis. But what if, on that same scenario, $85,000 went into the plan for the owner and only $15,000 was cost for the employees? Now the thing's humming. Now you're making some serious benefit. And maybe you do a combination of the two. Maybe you don't want to take it totally away from the employees, but now we have tools that help the owner get there. And then, of course, our show last week where we can layer on a Section 79 on top of that, we can combine qualified plans with Section 79 that really knocks the socks off.
Well, one point that you brought up, though, is really cool. Is we have a lot of agents that really are not knowledgeable in qualified plans.
Right.
So as soon as we start talking about that, they freeze or they put the pause button on the show.
Right.
But I want to encourage you, really, we have so much support for, especially 2 or 3 carriers that come to my mind, that are so deep in this. Their material is great. If you can just do basic data collection, and of course, some of you know, a lot of people have been calling Ken himself, because Ken is a consultant for Brokers Alliance. They'll call him and say, hey, Ken, can you help me with this case? Can you steer me in the right direction? And he can do that for you. And believe you me, whatever you're sharing in comp is nothing compared to the kind of knowledge you're going to get. And he's really the liaison into all these, whether it's third-party administrator, CPA, attorney, trust officers, any of this fiduciary market, this community. He can really introduce you and be a great gatekeeper and a liaison. I call him the emissary. So if you really say, if you want to do this, just go ahead and call Ken, and we'll run a line. If you just call him and say, hey, Ken Davis, we'll get you in touch with him.
Yeah, I just, part of my mission is I really think CPA should wake up to some of the stuff and understand these products and not be so derogatory towards them and start to understand they can be used properly. And I really like helping agents teach the attorneys and accountants how to do this. I mean, believe it or not, I spent 7 hours teaching 2 attorneys, 2 bankers, and a CPA last week, and they were just going, oh my God, this is great information. I'm so glad we came here. I mean, this was their words, and I was just kind of blown away. Well,
Ken, first of all, thank you for not inviting me to that.
That
sounded mind-numbing. Boy, to think about that, you got
7 hours, dude.
I hope you use big words, because that's what qualifies. If you're going to be a fiduciary, you got to have the high language, very high voltage. Listen, when we come back, we're going to talk more about some of this equipment. And remember, tomorrow we're going to be talking all over life insurance, the tax issues with annuities, and everything else. You're listening to the Business Insurance Zone, the show that focuses on insurance in your practice. You can email me, thebiz@brokersalliance.com, or call me toll-free, 1-800-290-7226, extension 147. Ken and I will be right back after a word from our sponsor, Brokers Alliance, one of the leading distributors of life and annuity products in the nation.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and interviewer extraordinaire. Before moving forward with anything you hear on this show, always check in with your CPA, your tax attorney, or your broker-dealer compliance department, especially when we're talking about issues like taxation, because that's their bailiwick. You can call me on any of the products we talk about, whether it's life insurance, annuities, DI, LTC, group pension plans, 1-800-290-7226, extension 147. It's not what I know, it's who I know. And that's why I have Ken Davis, CLU, ChFC, CFP, and CPA on the show. And any more, you going after it? Are you going to become a PhD in economics?
I'm done.
He's done. Boy, he is so done. I was done by the time I got out of my
I'm falling off the bone done. So.
Wow. Well, let's talk about the foreboding subject. And they say, Steve, what's the foreboding subject? Well, all you've been hearing in the political landscape lately, I mean, it's, there's Social Security, this, that, and the other, taxation on it. Is it a Ponzi scheme? I mean, it's all over the board. I'm not going to get into that today. I'm going to save Ken the political. I don't want to be duking it out with my buddy here. However, when we talk about taxation of Social Security, this is getting weird. We're going to be down to where this is all going to get taxed no matter where you're at. I mean, we're not there yet, but we keep getting there. Talk a little bit about the taxation of Social Security benefits and the things that trigger it, because I'm shocked, especially that capital gains issue we talked about. That was a newbie for me, and I could not believe how they kind of went backdoor on that to tax senior citizens on Social Security on a capital gain issue.
Yeah, absolutely.
Unbelievable.
What's interesting is there's a bracket creep type of thing. I mean, many years
Whoa,
ago.
bracket creep.
Well, inflation. I mean,
I know, but it sounds great. I just love that. Like, anytime Ken does something cool, like, he doesn't say 401k anymore. He just goes K plans. And when he goes bracket creep, I mean, we are talking about the edge of the hippest language from the CPA Society. Bracket creep. Okay, go ahead.
All right. Well, bracket creep basically is as inflation goes along, and 3% inflation, doubles in about 24 years, and there have been periods where inflation was much higher. And back in the 70s, that was one of the big things when Reagan got into power in the 80s, was to readjust these things. Well, what I'm saying is the government set up this process that said, okay, we want, it's this theme of tax the rich. And so if somebody's getting Social Security, well, that's fine, but if they're making a whole lot of money, we think we should tax some of that. Whereas before, when it was first put in place, we're all promised that it was going to be tax-free income. Well,
yeah. Promised.
The newer generations of Congress decided that wasn't appropriate and that it should be taxed, and of course they use this argument that we get to tax the rich. Well, at first, what they did is they put the first amount of income back to adjusted gross income, modified. Anything above that is going to subject part of your Social Security to taxes. So at first it was a 50%. In excess of this threshold. And then later on they came back and said, well, that's not good enough. Let's go to 85% of your Social Security being taxed if you hit certain thresholds. And at first the numbers didn't look terribly unreasonable, but look where they are today. And we've had this kind of bracket creep I was talking about.
This is why we sell our products, and I want you to, if you get anything we've said this week, this is a section I want you to start learning. And we have all kind of paperwork for this for you to support it. Go ahead, Ken.
So basically, married filing jointly, if they have modified adjusted gross income of more than $32,000 but less than $44,000, then 50% of their Social Security is taxed. If they exceed the $44,000, then the dollars start being included at 85% of Social Security. And here's one of those little nuanced, insidious types of things. We talked about tax brackets before, that you don't go back and apply this higher rate to the lower amounts of money. You pay at a lower rate for one stair step, a little higher for the next stair step, and then this additional money, marginal increase, is taxed at the highest level. Well, in this case, you do get a stair stepping initially, but as it pushes higher and higher, you can effectively have all of your Social Security times 85% being included in this thing. Now let's talk about modified adjusted gross.
But why do they say that, Ken? Because the mantra out in Washington is that that cap is at 85, but really it's not.
Well, it's 85, but you think part of it's 50 and part of it's 85, right. But eventually it gets 85 for the whole thing.
The whole thing.
And so unlike our tax brackets, it's a different computation, which is, I didn't get a lot of stuff until I started researching this whole taxation of Social Security.
But at our Monday show, we talked about marginal tax brackets that were progressive in nature. Remember we talked about this?
Right.
And now this isn't progressive.
I mean, this was more than progressive.
This is way more.
Smack you in the face. 85% of it's
okay,
taxed.
well, time out. I'm trying to figure out the government here. You know,
good luck.
We have this marginal tax bracket on ordinary income tax, but now when we talk to Social Security, it's like we said in marginal, it doesn't retro back, right, as you go up the higher bracket for income. But at Social Security, you're saying it hits the 85, and then it all goes back and catches the whole thing for 85.
Right. It slowly, it can push it into that fairly quickly. And so, you know, 32 grand of modified. Now let's talk about what modified adjusted gross income. It's not just gross income. It's your AGI on the bottom of the first page, and you add back in municipal bonds. Municipal bonds are supposed to be tax-free. Well, technically they are, but their earnings will impact whether your Social Security is being taxed. So it's really an indirect tax, isn't it? So let's call it what it is.
Well, I think you said the word, I love it, insidious.
Yes, it is insidious. It's evil. So you add that back in, and guess what? 50% of your Social Security income is added to AGI for this computation. So they're not only taxing potentially Social Security, but using the Social Security income that's supposed to be tax-free to determine whether it's taxable in the first place. Well, think about that. If you had $24,000 of Social Security income, and 50% of that's 12 grand, and all I have to do is cross over this 32,000. What's that mean? I just need 20,000 of other income. It could be municipal bond income. Remember, we were talking in the other show. They should go back and look at that on capital gain. You know, capital gains rates are 15%, but the entire capital gain is included in adjusted gross income. So cap gains can do it. Municipal bond interest can do it. Regular taxable interest can do it. Half your Social Security, all of your municipal bonds, all go into this calculation. So, gosh, is this really a very high threshold? No. 32 grand for married filing jointly is pretty quickly jumped to, and then we crossed the 44 shortly thereafter. So what was intended to tax Social Security benefits for the rich, this is very, very middle class and even maybe lower to mid.
I think it's punitive. I mean, you think of people that are retiring that are middle class or lower middle class are getting whacked on this big time.
Well, in individuals, 25 grand's the threshold. 34 for over that is 85%.
I mean, that's like what, 11.5 to $12 an hour, basically, if you want to convert it into earnings. I mean, it's ridiculous.
It is ridiculous, and I think it's fun when we finally get back to higher interest rates on CDs and bonds and stuff. This will become real evident as people start making more interest income and stuff like that as well.
And a heads up here, in our report, we have a nice 2-page provisional income test to see if your benefits get taxed. It's a great worksheet. Think about it. I could even do it on the first pass. I was in shock.
Yeah.
It's really easy to do.
This guy right here.
Couple pages, and you'll test the provisional income test on whether your Social Security benefits. And this is a huge, if you're looking for a seminar for geriatrics and seniors, this could be a big one. And a little side note, Ken, I have to say, I don't mean to be political here again, but back when I was in my late 40s, I was willing, and I had a few articles out there saying, listen, I'm willing to give everything I've earned on Social Security. I'm willing to give it back. 100%. Don't give me, just let me out of it at 50, right? But now that I'm in my early 60s, I have to say, I'm starting to say, hey, I want my money now, right? I gave you your option. You should have let us out when we had the chance, right?
Yeah.
Now they're talking about it. And here's the other thing I want to ask you about Social Security, because it bothers me, Ken. They keep telling me it's an entitlement. I thought I paid into this.
Well, you know, the interesting thing is that Congress can make laws currently, but the Congress changes every 2 years. There's new members coming and going constantly. And they made promises to us many, many years ago when Social Security was put in place that it wouldn't be taxed. Well, now it is. And now they're pushing it out. And, you know, quite frankly, Steve, I think the system is going to be so burdensome that I think it might just be that Social Security is 100% taxable if things keep going. And I think they're going to be pushing out the benefits past 67, maybe 70, 75. That's going to be how they're going to have to save the system, because otherwise it'll just implode. It's all.
I think that you've said a couple of things. One is it's going to be all taxable. I think that's probably going to happen.
Yep.
And then this thing about, especially for us boomers, I think we're all going to be sitting at 70. This issue of retiring early and Social Security is just out of the pitch. It's just out of the question.
But what's important to our viewers is what can they do to help their clients. And here's. If you want to get a little geeky, they just say Form 1040, line 20B as in boy. Why is that important?
Line 20?
20B as in boy, 20B. If you're in there talking to people that are taking their Social Security income, and you're looking for an additional sale or something where you can help them, just say, hey, would you mind if I took a look at your front page of your tax return? And you say, well, what's that about? So let me just look at it real quick. And if you see amounts on there, what that is that's the portion of their Social Security that's being taxed. So if you see $5, $10, $20, $30, $40,000 with a married couple of taxable income on Social Security, there's some things you can do with your products where you can reallocate from traditional taxable bond interest, municipal bond interest, maybe some cap gain dividend type stuff, into an annuity. And then when we do the show later on, we'll show you how to layer these annuities and use immediate annuities with deferred annuities that can impact this. And boy, it's not just, you may think the rates of return are low, 3.5% cap rate, but if you throw on $2,000, $5,000, $7,000, $8,000 of tax savings on top of that interest,
That's some money.
Do you think that might have an impact on somebody that's a widow that's 75 years old trying to make it and on the edge?
Again, but everything he's talking about, you can pull this right off of our 1040 by AXA, one of our good carriers who has given this to us to use. It's a great transparency. When we come back tomorrow, we're going to be talking about taxation, or I should say, the taxes of life insurance and annuities. Remember, you can view this show and all our shows on beautiful HD 1080p right on our on-demand section on our homepage. Just click on the red button at www.brokersalliance.com, and of course on all our social networks, Vimeo, YouTube, LinkedIn, Twitter, and Facebook. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.